Hello everyone, welcome to Let's Talk Trends. I'm Dawn, Content and Communications Lead of Lion Global Investors. Thank you so much for being with us here today. Joining us on this episode is Thio Siew Hua, our co-head of Asian Equities and the fund manager of the Lion Global Asia Pacific Fund. Welcome, Siew Hua.
Thanks, Dawn.
So, we have seen a strong start to 2023 in terms of global market performance, fueled by China's reopening, Europe's mild winter, as well as US better inflation data, sparking an optimism that now the Fed can engineer a soft landing. Indeed, the last FOMC meeting also suggests that the process of disinflation has begun. So this is a stark contrast to the bearishness we saw last year, where a lot of investors are very worried about a hard landing scenario. So how do we feel about a current market exuberance? Which camp are we on? Is it a recession, soft landing, no landing at all? How do we feel about the current performance, whether we still have legs to run?
Well, Dawn, you're absolutely right. Investors are definitely a lot more positive about markets in 2023. I think it reflects a lot more dovishness about inflation, about the Fed rate hikes, and also about the economy, because you've seen these rate hikes last year, close to 400 bips of rate hikes, and yet the economy remains extremely resilient. Unemployment levels are at an all-time low, and credit card spending is still strong. Meanwhile, you see inflation falling. So the expectation is that Fed rate hikes will peak, and we will see, a soft landing. Now, across the other part of the globe, I mean, you have seen this unexpected reopening in China, the ditching of the zero COVID policy, which took everybody by surprise. So that in itself gives the global growth another boost to growth, so to speak. All right, and the third thing is that if you look at global central bank liquidity, you will find that actually global central bank liquidity has actually been rising this year, and it's fueled by PBOC, it's fueled by BOJ, which has mitigated the QT that we've seen from the Fed and the ECB and the BOE. So all seems good, right? But what about, going forward? Can this continue? I think a lot of it depends on a couple of things. Firstly, we've seen 400 basis points of rate hikes last year. Will it hit the economy with a lag? Maybe we're just in this sweet spot where the US economy is still feeling the lagging effects of the QE. And these rate hikes take a while before they feed into the economy. So we could see a situation where growth really starts to slow, sometime this year. Secondly, inflation, right? With China reopening, that is going to add to inflation. And estimates run around, say it could boost inflation rate by 1% to 2%, thereabouts. So you could have a situation where inflation globally remains a bit more stubborn due to the China reopening. So all this, I think, will affect how it will affect how markets look like going forward. The third thing is, of course, China's growth policy. We've seen the reopening, this abandonment of the COVID zero policy, and that's led to the first leg of this re-rating in China. But going forward, we need more, right? We need to see whether the Chinese economy actually recovers or not. We need to see what their stimulus policies will be, because at the moment, a lot of it is like big sort of sweeping statements, this refocus on growth. Definitely 2023 is going to be a growth year. That is their key priority. So they've already set the policy, that goal. But how is it going to translate into the economy? So I think we need to wait until the 2 sessions in March to see what policies they will actually unleash and whether that will lead to growth surprising on the upside or not.
So I hear you that so we are cautiously optimistic on China. Am I kind of right to say? Because there's been a very strong consensus shift, right, over the last few months on how they view China. I think investors are also adding a lot of positioning to China over the last few months. It has recovered remarkably from its October trough. So how do we feel about that? How are we positioned right now in China?
You're right. It's increasingly a consensus trade, partly because, you're starting from a position of where, people were very, very underweight and very bearish on China. And you hear investors saying about how uninvestable China is. So I think we're coming from that position, and people post the abandonment of the zero COVID policy have basically reevaluated that and have added to their China position. Now, going forward, I think it has to be much more fundamental, right? China's gone from uninvestable to now investable, okay? So the next step is whether there is a fundamental reason to invest in China. Now, we are a little bit more sanguine on China. Sure, I think it's now pretty much the consensus that China looks quite good because you're recovering from a low base, all right? So the growth in China will look much more attractive than, let's say, elsewhere in the world. Secondly, China is easing. The US is still seeing the effects of QT, etc. So, from a liquidity standpoint, China also looks quite attractive. And thirdly, valuations are very cheap. And if you look at the sort of recovery that China is in store for, I guess it makes sense to stay invested in China.
Okay, so another question leading up to that, I caught on to the point you said China's reopening is going to give a lift to global economy. So where are the spillover effects, you think, right, that we could see some of the beneficiaries that we will see from China's reopening?
One very obvious country that will benefit from China's reopening is, of course, Thailand. Thailand, it's very dependent on tourism, and Chinese tourists form a big bulk of that. Yes. And over the last couple of years, Thailand's tourism has been unable to recover to pre-COVID levels, partly because the Chinese are kept out of Thailand. So I think Thailand will be a significant beneficiary of this reopening, of this revenge travel that we'll see from the Chinese tourists. The other area that I think has benefited is clearly on the tech side, on tech demand. If you look at smartphone demand in China, that's been depressed for a number of years now. Partly due to the fact that smartphone penetration is already very high in China, and also because the economy has been fairly lackluster. So now that inventory levels are low, already very low, and the replacement cycle is long overdue, there is an expectation that we will see a recovery in smartphone demand. And so you see the whole tech, that smartphone tech supply chain also move up with this China reopening.
Okay, it's great. So just to catch on again on the point that you said the tech sector, right? So if we take one step back and we kind of look deeper into the numbers in kind of this exuberance and market performance, are we actually seeing any sector rotation, sector shift, investors' preferences? So for instance, 2020, tech did very well. Last year was all about commodities and oil. So this year, is there kind of a sector preference in the markets? What do we think kind of like cyclicals versus defensives, value versus momentum, and stuff like that?
I'll speak in the context of Asia, and I think in China specifically, I think maybe it might be a year for the cyclicals, simply because growth has been fairly lackluster, and now that growth is coming back, this may be a good sector to be in. We have liked the Chinese internet sector for some time now. One of the reasons is because we view that as a proxy to the economic recovery in China. Now, don't get me wrong. I mean, these are no longer secular growth stocks, but they are proxies to the economy. So when the economy recovers, the likes of Alibaba, JD, Tencent, they will all do well, right? Now, the second reason why we like it is because we felt that the regulatory risk in this sector is receding. Now, you saw the sector go through a major regulatory reset, and growth in the sector has been held back as a result of this reset. Now, we think that this is largely done. So regulatory risk is receding very fast. You see that game approvals are now normalizing, and you see that Alibaba's kind of been forgiven since Ant Financial listing is now back on the table. So I think the regulatory risk aspect is going to be less of an issue for this sector, and valuations by and large still look fairly reasonable relative to the growth. Now, the second area that we like is the tourism travel. This revenge travel, because these guys have been locked down for over 2 years. So I think there is so much pent-up demand in this sector. So I think domestic tourism is one area, and of course outbound travel is another area. And we do see a lot of these tourism plays being huge beneficiaries, because not only do you have this this surge in top line, but you also have the operating leverage effect kicking in. So a lot of growth coming through for these names.
Okay, that's great. Thank you so much for sharing your insights with us today. So I can't wait to have you more on the show, maybe the next episode, to talk about the Lion Global Asia Pacific Fund.
Of course. Thanks very much for having me, Dawn.
Thanks, everyone. We are coming to the end of the episode. You are listening to Let's Talk Trends with me, Dawn Leong. If you like what you have heard, please subscribe to our show on YouTube, Google Podcasts, Apple Podcasts, and Spotify. Catch you guys next time.